Okay, good morning, everybody. I think it's afternoon. Good afternoon, everyone. Happy to have you here. Welcome to our training today on the global financial market. So we're going to be looking at what Forex is, kind of breaking it down and explaining it. I'll try my best to explain it in the most basic form as I possibly can. So as usual, if you have questions, just use the chat box and then just drop in your questions. I will definitely come back and answer your questions in due time. Okay. Yeah. Okay. Okay. So who am I? My name is Nana Obina Alexander. I am the head market analyst here at Anzo Capital. I'm also the head educator as well, and I'm a Forex trader myself. It's the major source of my income, aka the FX Jedi. So I used to be the head market analyst and trainer at Gemini Capital Markets and at Ivy Markets. I'm going to be your host for this training and for most of the trainings that you will be joining along with Anzo Capital. Okay. Now, the Forex markets, we're going to just jump straight into what we'll be breaking down today. The Forex markets has taken a lot of names. It has people as approach it in different way. People will bring up some Ponzi scheme and say they are trading Forex. The reason is because the market is so huge and it's so diverse, right? Now, you think the stock market is huge. So I'm talking about, like, let's say the New York Stock Exchange or the London Stock Exchange or the Tokyo Stock Exchange. All of those things. All of those markets are nothing compared to the Forex market. That's the largest financial market in the world. So we'll be covering today what exactly is the Forex market. How do you trade the Forex market? When it's traded, who are the participants in the market? Why should you consider trading the Forex market? And all of those points. We even go further into some of the ways that market participants actually trade in form of technical, fundamentals, and sentimental type analysis, and how you are affected as a person. Okay, so now, quite simply, the Forex market is a global market, right? The global financial market is the largest marketplace in the world where currencies are traded, right? So you think about it, currency, you're pairing two different currencies. Now, when you think of currencies, say the Naira, for example, against the dollar, you know that they don't have the same value, right? The value of the Naira and the dollar are not the same. They are changing relative to where the economy is, right? So if the Nigerian economy is performing poorly, you would see it weakened against the dollar. And similarly, you have the pound, the yen. All of what you're basically doing is every single zones or regions all have currencies that are associated with them, right? Okay, so basically, currency trading or trading on the global financial markets allows us to pair currencies together and trade them and try to make money. So if you've ever traveled to another country, you usually find that, for example, there's a currency exchange booth at the airport where you have the opportunity to be able to, change your currency to the currency of the country which you have just arrived, right? Now, those exchange booths, so you go there, let's say you're traveling from the US to Japan, for example, and you arrive at the airport in Tokyo, right? And then you want to change your currency, your dollar, to the yen so that you can spend and buy things. Now, so you get to the booths and you find out that $1 is worth, say, 100 yen, right? So you're like, wow, so $1 worth 100 yen. Okay, so how many yens can I get for this $1,000 that I'm with now? So you could do the math and you're like, oh, well, I have a lot of money right now. So basically, that's particular transaction. When you go to Bureau de Change or you go to, to any of those guys that sell dollar and you buy the dollar or you sell the dollar you are participating in this markets, right? That there is the most basic form of Forex trading, right? Forex trading is just simply the exchanging of one currency for another currency. But this time, we're doing it with the purpose of trying to make a profit, right? So for example, if somebody gives you $2,000 or $100 and you go and change it, you're just changing it to get the Naira that you can, work with. However, when we talk about trading on the global financial markets, what we're basically doing is we are purposely, buying in and out of currencies in order to make profits, because the value or the exchange rate of currencies is relative and it never stays stable. It is relative depending on what the market perceives or how the market perceives those economies are performing, right? Now, the foreign exchange market, which is also known as Forex or sometimes called FX, is actually the largest financial market in the world. Now, the Forex market is a decentralized market, meaning there are no control, there's no one governing body, there's no, just like the Naira is governed by the central bank, right? And then let's say the pound is governed by the Bank of England and all of those things. The Forex markets, right, unlike the stock exchanges, which have a central body, is decentralized. And so exchange rate is flux. The market is always in a constant flux. Price is always moving, right? Now, there's only a tiny percentage of currency transactions that happen in the real economy. So remember the example I just gave earlier about you arriving in Tokyo from the US, and you're trying to, you want to change the dollar you have to yen, right? Now that is Forex trading. That actually is Forex trading, but it's only a very small portion of transactions that actually involve that kind of transaction. The majority of transactions actually occur in speculative markets. So speculative market, like what you're trying to learn now, trading the CDF, the spot market, the futures market, that is where the volume, the main volume of currency trading actually happens. Now, currency traders, that is the reason why we're called speculators. What we tend to do is we tend to buy into certain assets or certain instruments with the expectation that at a future time, we will make profits when the price changes, right? I hope you're following along. And in order to show you, in order to kind of like illustrate the size, the huge, the immense, I call it size of the Forex market, what you have here on your screen is just different exchanges. So if you can see, you could see all of these ones so you have the New York Stock Exchange, right? So the New York Stock Exchange, which is the largest stock exchange in the world, has a daily trading volume. So every single day it has a daily turnover of about $22 billion. So about $22 billion is in constant movement in the markets, right? Now, the Tokyo Stock Exchange, which is the next largest, has about $18 billion. And then you have the London Stock Exchange with about $7.2 billion. Now, all of this are measly compared to the Forex market. In the Forex markets, trading on the global financial markets, we're looking at a daily trading volume of over $6.6 trillion. So on a constant, we have huge volumes of money being exchanged, as in huge transactions taking place in the market in billions of dollars, in trillions. And this is the market that we are learning to participate in. Now, why is this? Why are you looking at this, and why is this an advantage, and why am I showing you this? Now, think about it. If you have a business, if you're trying to set up a store, right, where would you like to have it? At a street where very few people pass, or at this the center of the marketplace where a lot of people are transversing? Well, it's quite easy. You want to have your business where a lot of eyes will see it, right? So because then you have better potential of doing more transactions, of making more money, right? So the volume in the Forex market is huge, and that's an advantage that you can take. That's something that you can take advantage of. Now, sure, not all the $6.6 trillion is CDF traders like you and me. A good percentage of that is done in spot trading and futures trading. But over $2.2 trillion is done by traders like you and me, trading the Forex market, looking for opportunities, and which is why you hear people, literally make tens of thousands of dollars in a single day trading. And I'm not talking about big banks, or I'm not talking about huge institutions. I'm talking about retail traders, who have substantial capital. You can make $10, you can make $100, you can make $1,000 trading. I've made $4,000 in one trading day, and it's nothing compared to the markets, right? So those are some of the advantages. Now, aside from the size of the market, one of the key advantages of the market is that it rarely closes. The market is virtually open round the clock. The Forex market is open 24 hours a day, 5.5 days a week, right? Only closes in the weekend. Now, so the market is open from Sunday 11 p.m. to like Friday 11 p.m. So the market is open around the clock. Why this is an advantage is that, well, you don't have to quit your job to learn this and be able to practice it, because you can fit it into your schedule. Depending on the type of trader you are or that you want to be, you can figure out what works for you. And don't worry, we are here to guide you through becoming the best trader that you can possibly be. Now, so unlike the stock and bond markets, the Forex market never closes. It doesn't have a closing time during the day. Instead, this is the main reason for this is because, well, remember we said it is a decentralized market. The Forex market is decentralized in the nature that it is not controlled by any one person or any one sector. So every single zones in the world is participating in this market. That means while we're going to sleep here, somebody else is just beginning their day. And while they are ending their day, somebody else is at the middle of the day. And as long as financial institutions in the world are running, the Forex market is in operation and you can participate in it. Now, the question is, well, what is traded in the Forex market? Well, the simple answer to that is money, right? Money is what is traded in the Forex market, specifically currencies. Now, obviously, there is commodities, you can trade stocks, you could trade all of these things on the Forex market. Well, the simple way to think about it is what we are basically doing is we are trading currencies, we are trading money. Now that can be confusing. So you say, how do you buy and sell money? Now, the way you want to view it is this. When you think of buying currencies, think of it as buying into a particular country, right? Sorry. Now, if anybody here has ever bought shares, right? If you've ever bought shares or participated in bought shares in companies, you know that the only reason you're doing that is because you anticipate, right? You are making a calculated guess, a calculated decision that share would appreciate. So you are buying into a country, sorry, into a share into a company because you expect them to grow, right? That's the expectation. Now, you can be wrong, you could be right. It's all down to how you do your analysis, you know, how you look at the financial statement and all of those things that you watch for in order to buy shares. So when you think of buying currencies, think of it as buying into shares of a particular currency. Of a particular country, right? So the price of a currency is directly proportional or is directly reflected in the market's opinion of its current economic state. Now, everybody understands that the Naira is, terrible, right? The Naira is just, has been dropping massively since like last year and even way further. You go back way further. It's not rocket science to understand that why the Naira is weak. That means why the dollar is appreciating against the Naira is because the economy is bad, right? Or the economy is not doing as well as it should do, right? Even somebody in the market understand that, you say everything is cost, dollar don't rise, right? What they're actually saying is the Naira is dropping because the Nigerian economy is dropping. So you think about currencies in that same form. In Forex trading, so like when you say, for example, you want to buy the Japanese yen, you want to think about it like you're basically buying into the shares of the economy of Japan, or when you're buying the USD, you want to think of it like you're buying into shares or buying shares of the US economy. Now, unlike shares where you need to buy those shares and you probably need to hold them for a long time to see appreciations, the beautiful thing about trading the Forex market is you don't need to hold trades or hold a position for a long time to see profits. You could get in and out of position within minutes, within seconds, because price is always on the move, right? So because it's basically the same idea, but the beautiful thing is you can get in and out quickly depending on how you want to participate in the market and still make money. The whole idea is the reason you buy shares is not because you just like the company's name, it's because you want to be able to sell it back at a higher price. So in the same vein, when you buy a currency, you want to be able to, when you sell it back, you want to be able to make a profit. So think about it. If you know that Naira, let's say when the Naira was 500 or 400, you anticipate that it was going to get up to 500 or 580 as it is now. Well, the reason you would buy is because you're anticipating the rise. And when you buy, let's say you buy $10,000 worth of, you buy $10,000 with your Naira, let's say at the time you needed 4 million Naira to do that. Well, when the price appreciates and goes up to like 500 and what you want to do is you go back and you sell back the dollar that you bought to make a profit. So you bought with the hope that the price would move in your favor. And the beautiful thing about currency trading is you can make profits both ways, whether price is going up or whether price is coming down. Don't worry, you'll see that in a bit. Now, who are the participants in the Forex market? Who trades Forex? Now, if you want to do any business, one very important thing you want to understand or you want to know is, okay, so who are the other people who are doing the same thing? And, what are they like? Well, it will impress you to know that the Forex market the reason it's the largest financial market in the world is because it has the largest players. We have the largest commercial banks. So when I talk about the largest commercial bank, we're talking about not your local banks, we're talking about big liquidity providers like Citibank, JP Morgan, Barclays Banks, Bank of England. We have all of these big financial institutions that are actually carrying out the majority of the volumes in the market. And then we have the central banks. The central banks of every single economy or every single country is a participant in the market because, well, what are we trading? We're trading currencies. Who controls currencies? The central banks of each zones or each regions. So they are a participant in the market, and what they do or policies they implement have a way of affecting the market. And as traders, you would learn how to take advantage. When economic times are going bad and everybody's complaining, if you understand your source, you'll be able to take advantage of every single market condition. I'm sure you've seen it somewhere that great investors or great traders make money when the market is good, but even make more when the market is bad, right? As bad as the economy has been since COVID, what has happened to somebody like Tesla or Elon Musk? What has happened to his network? It has skyrocketed, right? Why everybody's complaining, oh, COVID has shut down here, this has happened, that has happened. A number of people are making a lot of money still in that same economy. So economy is bad, times are bad, it's just relative. It's all down to your perspective, right? Now, other participants in the market also include small banks and institutions. So when I talk about small banks, I'm talking about, third tier banks, second tier bank, third tier, fourth tier banks, even your local banks like Zenith Bank, GT Bank, all of those banks, they have departments in them, such as the Treasury Department, that one of the key functions they do is participate in trading the Forex market, right? Now, and then there are institutions, multinationals, corporations, your pension funds, insurance companies. What do you think they do with your money? And then give you 5% per annum, right? They trade on the global markets, and earn huge profits and then give you a measly 3 to 5%, right? So all of these institutions are participating in the market. And then because of brokers, Forex brokers like Anzo Capital, you and I, like retail traders, can also participate in this market, okay? Now, the Forex market, we'll look at what are the Forex market hours. That means when is the market open? Well, the Forex market, like I mentioned, is open 24 hours a day, 5.5 days a week. And here is why. So as you can see on your screen here, this is just like a flat representation of time, of how time is, right? So you see that there's an overlap. Every time is continuous. It's continuous. It's like in a circle. And so we here in Nigeria are in the London session, right, where we fall in between this period here, where the most volume is actually done in the market, right? So it's actually quite good. Every single session in the market is actually good for trading, but this is where the volume in the market is actually quite bigger, at least for most of the currency pairs. And this is the reason why the market is open 24 hours a day, because you can see, while it's morning somewhere, it is afternoon somewhere, it is evening somewhere. So while this jurisdiction is closing, this other one is opening, it interlaps with this one, overlaps with this one, and then we have this. So the market is open round the clock because the big financial institutions or that do majority of the volumes are open, and you and I can participate in that movement. Okay, so the Forex market is open 24, not 24/7, but 24/5, right? And it's good for us because we can simply take advantage of that. Now, the objective of Forex trading is for us to be able to exchange one currency against another currency or with another currency, with the expectation that when price changes, we'll be able to make profit. That means the one we bought would appreciate, right? Now, I know we're talking about buy, sell, but what you need to understand is what is actually happening is actually an exchange, right? So when you think about, let's say you want to get a new pair of shoes, a new pair of sneakers, you think about buying sneakers, but what you're actually doing there is you're exchanging. So they say the sneakers is 40K and you want to get it, you love it so much, you want to get the sneakers. Well, in order to get that sneakers, you need to part way with your 40K. So you're exchanging your 40,000 for the sneakers. The same thing, that's the same way you should think about when you hear buying or selling of currencies. You don't just buy anything, you have to exchange it with something because you'll get something in return and you have to let go of something. So you're exchanging. And this is the reason why currencies are quoted in pairs. So you always find that currencies are quoted in pairs, right? Something like this, you see Euro, USD, GBP, USD, USD, JPY, and so on. Don't worry, we'll come to it in a bit and explain what all of this means in terms of GBP, USD, all of those things. Would break it down a little bit and show you some of the majors, the minors, and the crosses, right? Okay. Now, the reason currencies are quoted in pair, like I just mentioned, is that in every foreign exchange transaction, you are simultaneously buying one currency and selling another, right? So the whole idea is, think about it the same way you do transactions. So you go to the markets to buy a particular item. What you're doing is you are simultaneously both buying and selling. Well, in order to buy, let's use the sneaker example, for example. Well, if you want to buy a pair of sneakers, right? And you go to the store and they say it's 40K for that sneakers you want to get. Well, in order to buy that sneakers, you have to sell your money, right? That means you sell your Naira, 40,000 to be specific, to get that new pair of sneakers. And the person who is selling to you is actually selling the sneakers to buy your Naira. So currency trading is just simply the simultaneously buying of one currency and selling of the other. So that is why they are always quoted in pair. Now the question will be, how do you know which one you're buying and which one you're selling? And that is where the concept of currency quotes and currency base currencies and quote currencies come into place. Don't worry, I'll show you an example of currency quotes and we'll look at it together. Now, buying and selling of currencies. Now, currencies are traded. So currencies are traded through a brokerage firm like Anzo Capital and or CDF providers, and that is the only way you can actually participate in this market. Now, you cannot just go to ShopRite or go to wherever it is and say you want to buy Euro USD or you want to trade on the market. Well, the only way you can access this market is through a brokerage platform, and that is why we have Anzo Capital. Now, Anzo Capital, we are one of, if not the best platform in the country. Don't worry, when it comes to any bit, I'll show you why you should want to trade with Anzo Capital, why you should choose Anzo Capital as a brokerage firm, and why we stand out. But Anzo Capital, we provide you direct access to the market to be able to trade CDF's currencies. And not just that, we provide you top-notch educations and follow-up classes. So we want you to get good. We want you to do well for yourself. And so we continue to provide you what you need to succeed in the market. Now, just like we said, say you want to buy euro dollar, so you have this currency quotes here, as we have here as Euro USD or the pound USD. You'd always find that currencies are quoted in pairs. Now, when you say you want to buy Euro USD, you are doing two things, right? When you buy a particular currency or when you buy a particular pair, because you don't buy one currency, you buy or sell a pair. So you think about this, for example, or you think about GBP, JPY, for example, you think of it as one pair, right? So you're dealing with one pair, right? You can either buy or sell that pair. Now, when you buy or sell the pair, you're actually simultaneously buying and selling. So you're buying one and selling the other, or you're selling one and buying the other. Don't worry, I'll come back to this in a bit and will explain it even further. Now, when you think about exchange rate, the reason there is profits in this market is because exchange rates don't stay the same, right? The value of the dollar against the euro in January 1st is not the same it is now. Even if it is the same, before it has moved a lot of way to get there, right? But it's most likely not the same, right? Even the value of the Naira to dollar the 1 hour ago is probably different from now because price is always moving. And one of the key things that affects this is all down to economics 101, demand and supply, right? The exchange rates are always constant flux. Think about it like a tug of war. So let's say you think of let's use this illustration here. So let's think about this section as euro. The USD. Let's assume this is USD, and then let's say this part is JPY, right? It can be Naira, it can be anything. But let's use JPY now. So they are buyers and they are sellers. So if there's more demand for the USD, that means if the dollar is stronger, well, they will pull price toward their direction, That means it will be much harder for these guys on the left to survive. That means they'll have to pay more of their currency to get, the same amount of dollar. So depending on who is stronger, right? If you have a set of people here, let's say we have 10 people of equal strength, all holding on to this rope, and here we have 6 people. Most likely you will see price would move towards this direction. And that's what is happening constantly. Every single minute, every single day, price is always moving depending on where there is higher demand or lower supply. It's all down to demand and supply. Price doesn't, that's the only thing price cares about: who has the most demand or where is the least amount of supply coming from. It's the same reason why, during the heat of the peak of COVID, we had face masks became extremely expensive. Well, it was because there was more demand for it and there was little supply, right? Before COVID, nobody even thinks about face masks. Nobody even buys it. I'm sure it probably would sell for like 20 or 10 naira at the time. But at the height of it, I think I bought one for about 500 naira for just one face mask, right? So, but the reason that happened is because there was now more demand for that asset. So you think about currencies, all you're thinking about is tug of war. So you think about two currencies. When you hear, let's say this is Euro USD, so we're going to use Euro on this side, we're going to use this as Euro. So Euro USD pair is all about the Euro and the USD pulling between themselves. Now, what we are trying to do is we're saying, okay, I think the Euro is going to be stronger, so I'm going to buy the Euro against the dollar. And if you're right, well, you make money for that, right? If you think the dollar is stronger, well, you buy the dollar against the Euro. And when you're right, well, you make money for that. Now, if you're wrong, you could also lose money. But this is the reason why you're learning how to manage your risk and how to do this properly. Every single business, there's always cost of operation. The same thing applies when you're trading Forex markets. There's no Forex trader, there's no Forex trading without risk. It's all about managing risk. The goal is not to eliminate risk. If you want to eliminate risk, sit in your house. Well, even if you sit in your house, you might just develop arthritis. So there's always risk. You have to take calculated movement in life. Now, we've been talking about currencies, but there are some major currencies that are traded in the market. There are some minor currencies that are traded in the market, and there are some currencies that are not even traded, e.g. Nigeria, the Nigerian naira. So, but here, jokes aside, here are the 8 major currencies in the world, and these 8 major currencies are most of the time what you will be dealing with. Now, so if you look up in your screen, you would see different currencies associated with different flags of different countries. So up to my top left, we have the euro, which is the legal tender or the money used in the European zone. And then we have the GBP, which stands for Great British Pounds. Then we have the AUD, which is for the Australian dollar. Then we have the NZD. And then, of course, we have the elephant in the room, which is USD. Then we have Canadian dollar. And we have Swiss franc. Then we have the Japanese yen. Now, all this constitutes the 8 major currencies, currencies that we can trade. But here's the thing. Remember, I said currencies are always quoted in pairs, right? So you don't go and buy euro, or you don't go and buy NZD, or you don't go and buy the USD. It's bought against something. Even when you think about it, you don't just buy the dollar. If you buy the dollar, you have to use something to buy it. In this case, let's say you use naira to buy the dollar. So you're buying the dollar, selling your naira, or against the naira. Now, these are the 8 major currencies. However, currencies are quoted in pairs, right? But out of all of this, the biggest and the most, liquid of them is the USD. So it is the main currency, right? Now, it is the major currency amongst all of them. So for that reason, any of these currencies that are quoted with the USD is considered a major currency pair. Now, if you look up in your screen, you would see that the one similarity that lies with all of these things here is that they all contain USD, right? So you have Euro, USD, Pound, USD, USD, JPY, USD, Swiss franc, USD, CAD, AUD, USD, and NZD, USD. Now, all of them are part of the major currencies, right? But if you see that they are all paired with the dollar, and so they are considered a major currency pair. The reason we consider them major is because the majority of volumes or liquidity is actually done with, again, across this instrument, right? So this instrument constitutes the majority of the volume in the market. Now, doesn't mean the others don't have volume. They have huge volumes as well. We're talking about trillions and trillions of dollars, but these are the major currency pairs. And the foremost of them is the euro dollar. So the euro dollar is the most traded currency pair in the world, right? And that's why you find a lot of traders, trade that a lot as well. Now, besides the major currency pairs, there are also, so if you go back to our example here, you would see that, well, sure, currency are quoted against each other. What we just did is just pair all of them to the dollar, right? So we paired all of them to the dollar like so. So you think about, a permutation of something like this. Now, in the same vein, you can also have a pairing of all of the other currencies without the dollar being involved. And if we have such a case, well, that is where we now come into currency crosses. If you look up, you'd also notice that while all of these currencies are part of the 8 big currencies, they don't contain the dollar. So they are considered crosses, right? Currency crosses, right? Now, so you see like euro pound, euro Swiss, euro CAD, euro Aussie, and all of that down to NZD CHF. All of these are still currency pairs that you can trade in the market, but they are considered currency crosses. The reason I'm pointing out this information, so for example, you probably hear on Bloomberg or stuff, you hear currency crosses, or you hear the greenback or the kiwi, all of those things, they are referring to instruments like this that you keep, that you see. And these are part of the things that you can trade. So the amount of instruments that is tradable, that open for you to trade in the market is huge. So you have diverse options to trade with. Okay, now the question now is this: why do price fluctuate? Because remember, the only reason we're able to make profits or take advantage of this is because price doesn't stay the same. Why the price fluctuates? Well, the simple answer to that is demand and supply. The reason price moves is because it's either there's more demand or there's less demand, or there's more supply or there's less supply. Depending on which one is the case, price would move in that direction. Now, just like in every business and sales, the more demand, if people want a particular item and more people want a particular item, well, the price would go up, right? If fuel becomes scarce, and that means more people want to get it, but there's less available supply, well, it becomes more expensive to get it, right? Similarly, when there's too much supply than there's required demand, the price will drop. So the more demand there is in the currency, the higher the value would go up. So if an economy is doing very, very well and more people are trooping into it, right, what will happen to the state of the economy? Well, to get stronger. What will happen to their currency? Well, it would also get stronger. And or the opposite would be the case when the economy is performing poorly and less investors are trying to do business. If every single investor is trying to get away from an economy, well, you start to see the price drop. Now, there are certain things that could affect, this need for demand and supply. So things like economic policies, political issues, even things like natural disasters can also affect price in currency. So you see that a lot. You think about the Russian ruble before the whole Ukraine-Russia war or tension. Well, you saw what happened the moment the whole war outbroke, right? So we had the outbreak of the war, then the price or the value of the ruble just dropped. It even affected surrounding nations. So it affected the euro, it affected even the Ukraine, it affected Polish, it affected the euro in particular because they had business relationship with them, right? So there are certain things like economic policies, political issues, natural disasters, even wars. All of these things, while bad in themselves, like it's bad, it's terrible for bad things to happen. But the thing is, every single thing provides a source of, what I call it, provide a source of opportunity. So whether it's bad or it's good, it can be viewed from a perspective where you can take advantage of it, right? Now, price also reflected on technical parts. So when we start looking at different ways you can make analysis in the market, we'll look at technical analysis as well as fundamentals, okay? Now, what are the types of analysis? Remember, so what the point I hope that I have established is the fact that, well, all we are looking to do is take advantage of the fact that price is always moving, right? We are trying to take advantage of the fact that price is always on the move. And so we need to find a way to analyze the market to make decisions as to whether we want to buy or sell a particular instrument or a particular currencies, right? So think about it. Before you go into any business, you would have done your business plan and figure, okay, so if I can get it for X amount, I should be able to sell it for Y amount and make a profit. Okay, if I can get it, I should be able to sell it here. If you just decide to go and, you like it and you go and buy it and you start selling it and nobody wants it, well, it's because you did not do proper analysis before you started the business. Now, when it comes to trading on the global financial market, we also need to make analysis. Now, there are three, basically, there are two forms of analysis. I have three on the board here, but the third one is not necessary analysis. But there are two major forms of analysis. There's the fundamental analysis, there's a technical analysis, and there's also sentimental push as well. Now, let's start off by looking at fundamental analysis. Now, fundamental analysis is simply, so when you think about fundamental analysis, just simply think about, you're looking at the states of the economy before to value the currency, right? So basically, if an economy is performing well, it means a number of things. So if an economy is doing well, what will happen? Well, more businesses will want to operate in that economy, right? If more businesses are operating in the economy, what would they do? Well, they'll bring in more money to the economy. If more money if more money is coming into the economy, well, they would have better, a better economy nonetheless. And so what will happen? There'll be more demand for that currency. And what will happen to the price? Well, the price will go up, right? Now, this is always relative. For example, we can have a good economy, and then you can have let's say the US economy is doing very well, for example, and then you also have another economy like the Japan economy, or Japanese economy also performing very well, right? So it's not be relative based on which one is better, right? So because remember, we are pairing currencies. We're not just buying one asset. We are trading a pair. So let's say the Euro USD, the Euro GBP, or the USD JPY, or whatever the case is. Now, so a good economy would result in a higher currency value. This is the reason why fundamental metrics like interest rates, the GDP, non-farm payrolls, we have things like unemployment rates, FOMC, all of these things, if depending on the results. So if we have lower unemployment, so that means more people are employed. But if more people are employed, what does that mean? More people will have money to spend. What does that mean? The economy will do better, right? If less people are, if less people are unemployed, more people, that means more people are working. That means more money is coming and everybody's happy. That means more people would even spend. However, if the unemployment figure is massively crazy, but what it means is, well, it's bad for the economy because less people have money to spend. That means less people have money to even buy the necessity, not to talk about buying luxuries, right? So the better the economy, the higher the currency value, and the lower the economy, or the worse the economy, the lower the currency value. Now, don't worry, in subsequent classes, I would actually be showing you how you can track those economic metrics that are important. You don't worry, you don't need to now become a financial guru in the sense that you need to start watching Bloomberg and trying to read all of those things. But you would be able to figure out some of the key metrics to watch, how to watch for them, and how you can look to take advantage of those economic or fundamental reports coming out from the markets, right? Now, the next type of analysis, which is actually where you'll be spending most of your time on, is on technical analysis, right? Now, technical analysis, I'll say, is the same thing as chart analysis, right? So a fundamental analysis, we're looking at the economy. So trying to see, okay, well, if the economy is doing well, if the fundamentals coming out are nice, then at least I can project that this is going to perform like this, or that is going to perform like this. However, with technical analysis, what we are basically doing is we are looking at the technicals, we're looking at price patterns, because what we notice is that price tends to show the real states of, we can find the value, we can find a projection in price when we can figure out by looking at what price has done before. So what that means is by looking at previous price action, we can forecast future price movements. Because remember, the goal, the only way we make money is not assuming that price will go up, but it's actually as knowing that price will go up, or figuring out, thinking that price will go up and then buying into it. You can say to yourself, this thing is going to appreciate, it's going to appreciate. If you don't buy into it before it appreciates, when it does appreciate, it doesn't do you any good, right? But if you had bought into it while it was low, you can then sell back when it's high and make a profit. So technical analysis is all about looking at the charts, price movements, and then trying to figure out how you can take advantage of it. Don't worry, we'll be spending a lot of time, teaching you the basic of technical analysis, also teaching you how you can start looking at things like demand and supply, how you can approach the market from a perspective of, let's say, smart money concept trading, or support and demand. Just different ways you can analyze the charts and try and make a decision as to what price is potentially going to do and then make money. Now, sentiment analysis is not basic, it's not really a type of analysis. It's just simply, market feeling, right? There's this crowd mentality. Think about sentiment analysis as crowd mentality. So sometimes, there's no logical reason why something happens, but just because everybody is scared, and then you just see price move in that direction. There's no real way to gauge this, but we know we have to keep that in mind, that there's a psychology to the market that sometimes is affected by sentiment. Now, the Forex market is actually a market for everyone. And the reason is, well, because of the way the market is. Now, there are different ways you can approach the market. There are different types of traders in the market. It all depends not just on, what you prefer, but also on, your the resources you have available to you. Now, there are 4 different types of traders. There is, the first one that you can see on your screen to your right is they are called position traders. Now, position traders are traders that look for long-term movements in the market and try to get involved, holding those positions for a long period of time, right? Sometimes for weeks, for months. They might be in a position, holding the position for a long period of time, to make a decision, not necessarily not to make a decision. They will hold on to a position, they'll buy into a position and hold on to that position for a long period of time, right? At the end of the time, when they close their trade, they could pack up, racking millions, if not hundreds of thousands of dollars. Now, this type of traders, especially the ones that do it in a much bigger way, are usually big institutions that trade with huge capital sizes. Now, you can be a position trader, entering into trades and holding them for long term. Position traders are just basically traders that use long-term strategies. So they're not focused on, they're focused on the fundamental, right? Most of the time as to, okay, looking at this economy versus this economy, I expect this to do well, right, against the other one, and then try to, maybe buy into it with a, let's say, 6 months, 5-month projection, maybe a year projection, maybe 5 years. And at the end of the day, they come out, at the other side with billions of dollars in profit. And the next type of traders are swing traders. Now, swing traders are traders that they try to take advantage of swing in the market. Because here's one thing you need to know about price. Price doesn't move in a straight line, right? The market rarely ever moves in a straight line. When the market wants to move, you would find that what will happen is price will move in something like a wave-like pattern, right? And we call these swings, right? You can see that, price is resultantly going up. However, it is not going up in a straight line. It is making waves or swings, right? So swing traders are traders that tend to try to take advantage of those inside swings in the market. So if they can figure out a bullish market, okay, we can figure out the market that is potentially going to go up. They want to ride this swing, maybe buy at the low price, get out at, take profits, and then maybe wait to get in again at a much later time and try and get in and get out. So swing traders, the way you think about them is they're traders who, they tend to, hold positions for anything between 1 to 5 days, maybe more, but they hold position for, a number of days. Sure, they can close, you can open and close trade within the same day, but they are comfortable holding positions for a few days or maybe a few weeks, right? And then we have the other type of traders, which is where we have the day traders and the scalpers. And the day traders are traders. These are traders who they look to do analysis in the market and just they try to get in and out of the trade. They want to execute a trade and get out within the same day. So let's say at the start of today or within the day, open a trade and close it, before the end of the day. I don't want to hold it all over to the next day and so this type of traders, they try to get in and out of the market, within the same day. They will take more trades. So you can start to see the difference, right? While a position trader might take few trades, maybe 1, 2, 3 trades every 5, 6 months. And a swing trader could look to get into, 1 trade every day or 2 trades every day. Less actually, maybe 5 trades every week or something like that. A day trader might get in and out of positions multiple times, right? Make profits. They use different time frames, smaller time frame, and they target smaller targets, right? So they go for smaller targets, or what we refer to as pips, right? So day traders are such type of traders, and then we have scalpers. Now, scalpers are traders that they want to get in and out of the market within minutes, maybe seconds even. They want to get in frequently, get out frequently. All of these different systems have their own advantage and disadvantage. Now, there's no best one. It's all down to what you're comfortable with. Some people are not comfortable, holding positions. They don't have the temperaments to do that. Some other people, actually don't even have the time, right? So you might just look at the markets, make analysis. Let's say over the night, you place your trade, in the morning, and then you want to just maybe have 1 or 2 times to monitor it, and then close the chart. If you want to scalp, you need to have enough time to sit in front of your chart and just be looking for those opportunities to get in and out quickly, right? So it's all down to you and what you prefer. Now you will be learning how to read the market, how to analyze the market. As you go in that, you will be able to discover what style of trading suits you. Now, we're going to need to get familiar with some terms. So we've talked about some general knowledge. We'll now have to start zeroing down into some more specific knowledge. So we're going to be getting familiar with some terms. So some of the things we'll be using. So in some subsequent classes, so when we're mentioning them, you would have an idea. You would know what we're talking about. Now, one of the most important things that you need to understand as a trader is the concept of PIP, right? And what is a PIP? Well, a PIP is the smallest denomination of any, that any currency pair can move by. So think about this. When you think of time, right? So you think about the concept of time. What's the smallest time that we deal with? Well, there's the hour, there's the minute, and there's the second. So basically, we deal with the second, right? So if you want to time somebody, you give them, I'll give you 5 seconds to get it done. Now, what that means is the way price appreciates, or the way we calculate time is relative to per second, right? Now, what a pip is actually the smallest value by which a currency can appreciate or depreciate by that we are interested in. Now, back to our example of time, just because mostly we are usually concerned with the seconds and minutes and hour, doesn't mean that there's no time lower than second. There's microseconds, right? For example, in sports, for example, in racing or Olympics, where you have runners, the time that they are calculating is not in seconds, it's actually microsecond, where about 10 of a microsecond makes 1 second, right? Now, everybody might run 9 seconds, they might run 100 meters in 10 seconds, but the person who comes first might run 10 seconds, 10 seconds and 10.1, the other person might run 10.4, the other one might run 10.9. From the way we would look at it, they all run 10 seconds, right? However, there is a fraction of it in terms of the way the Olympic runners would look at it. In the same way, when we think about currencies, right? So when we think of currencies, for example, the dollar, right? So the dollar, the minimum, the lowest denomination of that currency is the cent. So we have $1, and so it can look like this: $1.20, right? So this would represent $1.20, right? Now, how many cents makes up the dollar? About 100 cents. When you're thinking of currencies, the smallest value is usually, so for example, in the case of dollar, is the cent. In the case of naira, would be kobo. However, when we're talking about trading on the CDF market or trading on the Forex market, we're dealing with even fractions of a cent. While this is $1.20, in the Forex market, there are values behind here, right? So this will be $1.20, and then, let's say 1 pip. I don't worry, I'll come back and I'll explain this even much further with the next slide. But what you need to understand is, beside the actual last digits that you would deal with, so this would have been $1.11, right? There are fractions, that price actually move before it gets to a cent. So if we're using the example of the cent here, when it comes to Forex trading, right? When it comes to trading the Forex market, well, 100 pip is equals to 1 cent, right? So 100 pips makes 1 cent. Now, don't worry, you don't need to do maths. You don't need to understand so much math and be doing so much calculation, but you need to understand the concept of what we're trying to explain, right? Now, when you look at this, right? Okay, no, this doesn't explain what I'm trying to say. Okay, I don't think I have that slide here. Okay, so basically, when you think of a cent, 1 cent is equals to 100 pips, right? So 1 cent is equals to 100 pips, right? That means this $1.21, right? In the way we look at it in the Forex market, it's actually $1.21 and 00 pip, right? Now, what this means is, before this thing will go from $1.21 to $1.22, which is actually nothing when you think about it. So from $1.21 to $1.22, it would have moved 100 places. That means it will move from $1.21 00 pip to $1.21 01 02. So it will go like this. We'll have, let me do this. So this would be the first, the next one will be 01, then we'll have 02 up till 0 to 21.99. So this is going to be points. And then after this, before it goes up to 1.2. 1.22. So you can see that before it goes from $1.21 to $1.22, which seems like the next step, it has actually moved 100 places. This is the reason why, trading the Forex market gives more money than actually buying and selling currencies when you buy them physically. But when you buy the dollar, if it appreciates by 100 pips, there's no way for you. Just all you're looking at is when it gets to increase by 1 naira. Or you buy at 508. Who is that? Please keep your mics muted. Okay, lost my line of thoughts there. Well, so when price appreciates, the way we look at it as Forex trader, we are concerned with even fractions of the actual currencies, which is why we can make a lot of money even in seemingly small movements in price. Okay. Now here's an example of a currency quotes, right? Here's an example of a currency quotes. Now remember I said currencies are always quoted in pairs, right? You don't buy one, you buy them in pairs, or you trade them in pairs. So for example, just like you have on your screen, we have the euro dollar, right? So this is what this means is the euro, that means the currency to your left. Always think about it. The currency on your left, that means the first one when you're reading it, is considered the base currency, right? And the one on your right is the quote currency. So you read this as, say, euro dollar. So if it was, let's say, dollar yen, the dollar will be the base currency and the euro will be the quote, the yen would be the quote currency. So the one to your left is the base currency and the one on your right is the quote currency. Now, you can see that, this is an example. You can see we have two prices. Now, when you're trading, don't worry, when you download the MT4 app and you're trading, when you want to place a trade on any instrument, you usually find that there are two prices, right? There are two prices that you mostly see. Now, the reason there are two prices is because, well, one of them is considered the bid price and the other one is the ask price. And if you notice, there's a slight difference between both of them. In this case, the bid price is 1.1524 and the ask price is 1.1527. It's still $1 or $1.15. However, the PIP value here, the way you read this is $1.15, 24 pips, more or less, right? This will be 27 pips. Now, you can see that there's a slight difference between both of them. Now, the difference between the bid and the ask price is what we call spread. What is this now? The difference between the ask and the bid price is what we call spread, right? And that spread is the broker's money. That's how the brokers make money, right? It's just the same way. So you think about it, when you go to bureau de change and you want to buy dollar, you want to sell dollar to, to a person who buys or sell dollar, the price at which they buy from you is different from the price at which they sell from you. The difference between the buying price and the selling price is their profit. So, for example, the dollar might be the price of the dollar might be 580, right? However, they won't sell 580 to you. They will sell maybe they'll probably sell at let's say 590, right? Or 585. But if you want to sell to them, they will not sell to you. They will not buy from you at 580. They'll buy from you at say 575. Right? So the difference between the buying price and the selling price is actually what is the spread, and that is where that is the brokers, that's how the brokers make profits, right? Now on Anzo Capital here, our spreads are really tight. We have tight spread, and you can see just 2 pips. Like 2 pips is nothing. Like for example, our spread on Euro USD is like 1.5, 1.6 pips, even on ECN account can be as low as 0.1, right? So you wouldn't even feel it. It's just huge volumes in transaction is where the profit is made. Okay. Now, I'm going to, for people who you'd see currencies look a little bit different, so how to be able to understand which one is referring to the PIP. Now, for dollar pairs, for currency pairs that have, just one value before the decimal place, right? If there's just one value before the decimal place, the PIP is the 4th decimal place number, right? So you can see in this case, there's just 1 point, right? The PIP is the 4th decimal place number. For instruments that have more than one value before the decimal place, the PIP is the 2nd decimal place number. You can just ignore the last one. So you can see I'm ignoring this 2 here because they are fractions of a PIP, right? So when price increase, we see those increments in PIP value, right? So in order for this to go from 1.13 to 1.14, it first needs to get up to 1.1399, and then the next one will be 1.14. Okay, so for not necessarily non-JPY pairs, but just think about it in this way. For pairs that have just one, you can see there's just one number here. It could be 0. You could have 0 points, but as long as the value here is not more than just 1 digit, then the PIP value is the 4th decimal place number. Okay, now let me clear all of this. Now, lot size. Now, the next important point that we're going to discuss here is lot size. Now, the reason I'm explaining all of these basics is because, well, and the reason I'm recording is so that you can always rewatch it and understand them, right? So that when we now get into the real meat of really trying to do analysis, trying to understand support resistance, trying to understand demand supply, then you already have a basics. So when we are discussing them, so we're talking about those things, you already understand what they mean. Now, the lot size is just simply, the way you think about it is it's simply the value of your PIP, right? Now, remember when we place a transaction, the price increments or decrease by in pips, in multiples of pips, right? So now there are three major types of lot sizes. There's the standard lots, there's the mini lots, and there's the micro lots. The main thing you want to understand here is this. For a standard lot, right, each pip is worth approximately $10, right? So if price moves up 1 pip, you made $10. If price moves up 10 pips, you just made $100. For a mini lot, each pip is worth approximately $1, right? If price moves up 10 pips, you just made $10. And for a micro lot, each pip is worth approximately 10 cents, right? So you do the multiplication. If price moves up 10 places, you just made yourself $1. Now, here's an example of using a pip and a lot size in one phrase. Now, let's say we make a transaction, we bought Euro USD, right? The profit or loss, right? The profit or loss you make in any single trade is dependent on the value of the number of the pips you captured times the value of your lot size. So let's say we bought Euro USD at this price. So this is the price at which we bought Euro USD. So 1.1900. So if we buy, we're expecting price to go up, right? If we buy and price goes up, well, we're making money. Now, so we bought at 1.1900, and then price goes up to 1.1950. What happened here is we just made 50 pips, right? So we made 50 pips. Now, what would these 50 pips be worth? Imagine if all of us here took this trade, or let's say everybody here took this trade. Some people use a standard lot because they had a bigger account. Some people use a mini lot because they have, because of the account size, and some other people use a micro lot. Well, even though everybody would still make 50 pips, right? Somebody who trades a standard lot, that 50 pips will be worth $500 for him or her, right? So just 50 pips, price moves 50 pips, less than a cent, you've made $500. And this can happen in 2 minutes, it can happen in 1 hour, it can happen in 3 minutes. Price is always moving. So, but the same transaction, somebody who makes 50 pips and used a mini lot would make $50. And somebody who used a micro lot and made 50 lots or 50 pips will make $5. So even though we all make the same amount of pips, the value of the pip is now dependent on the lot size that you're using. Now remember, it goes both ways. If you're making profits, you will make an increment of that lot size. If you're making losses, you'll also make an increment of that lot size as well, right? Now, it's just the same way you think about shares. Even if everybody bought into a particular share at the same price, as long as they don't buy the same number of units, if the price appreciates, they will make different amount of profits. Okay, I hope that is clear. Now, let's just run through some other terminologies before we are coming to the end of this class. We'll run through some other terminologies that you need to know of that we'll be using in subsequent classes. Now, so when you hear traders, make the statement, use this long, you hear long or short. What it simply means is buy and sell. So when you hear long, think of buying, and when you hear short, think of sell. So long means you're buying, that means you're expecting price to go up. Short means you're selling, that means you're expecting price to go down. Now, take profits and stop loss are parameters that we can set. So when we place a trade, you don't have to sit down in front of your computer or holding your phone, watching price as it moves. You can set a target and a maximum risk. So let's say we place a buy at this particular point here. That means we're expecting price to go up. Now, I can place the trade and just set a take profit at this point here. What that means is if price goes up to this point, the moment it gets here, it will close that trade and give me whatever profit I have made, which is the number of pips I made times my lot size, right? Minus spread, obviously. Now, even if price continues to go up, we would have exited our position here, right? If price gets here and then goes down, we would have also exited our position here because we would have still made profit. Now, stop loss is a risk management parameter where, let's say we are buying at this point and we are trying to go for this target, right? We can now say, okay, wait, in case I'm wrong, I don't want price. If price gets to this point, close the trade. I want to exit. So if market goes down like this, well, you won't be in this position because it would have closed all the positions for you at this point, right? So this enables you to make your analysis, place your trades on the instruments that you've analyzed, and then you can just go out and do your thing, knowing that when price gets your to your targets, it would close the trade on your behalf. Okay. Okay, so somebody says explain pips and lot size. Don't worry, I'll come back to that in a bit. Let's just run through this one. Now, leverage. So in order to trade in this market, you would be offered leverage. On Anzo Capital, you can get leverage up to 1:1,000. And this is what we would offer you. That means this is the reason why you're able to trade. It's the reason why you can fund your account $100 and be able to trade. If not, you would need to put up like $100,000 to even trade the market. But because of leverage, we can have the ability to do more. Now, bulls and bears, when you hear of bulls, just think of buyers. So bulls represent buyers, bears represent sellers. That means when you hear bullish, so they say the market is bullish, it means buyers are in control. So a bullish market refers to a market where buyers are in control. So what you see in a bullish market is price is going up, right? You'll notice that anytime I draw price, I don't draw it in straight line, because even though you can see price is going up, it's not going up in a straight line, it's going up and coming down, making waves, right? So this market is bullish because you can see that resultantly, well, price is going up. Each time, it keeps going up. So this is a bullish market. A bearish market, on the other hand, is a market where sellers are in control. And what you find in a bearish market is that price will be going down, right? Now, we can make profit in any single direction. You don't need price to be going up for you to make money. If price is going down, we can be making money shorting that pair, right? So we can be making money selling that instrument, okay? And then sometimes the market doesn't move bullish or bearish, it just moves side to side. So we call that a ranging market or a sideways market, where you find that the market will move in a range like this. And you can also make money, buying buying support, selling resistance within this range, okay? Now, so all of this concept, all of these terminologies, don't worry, you'd see us explain them, use them in our subsequent classes as well. So I'm just going to quickly go back and explain this pips and lot size. So basically the way you should think about it is this: price moves in fraction. The way we look at price as Forex traders, we look at fractions of a price of an instrument. So let's use the Naira and the Kobo, for example. The lowest denomination of the Naira is the Kobo, right? So we have this. This can be, so we can have 10 Naira. This will mean 10 Naira, 50 Kobo, right? Now, we don't trade Naira, we don't deal with Naira in the Forex market. But this is just to give you an example. Now, a pip, right? A pip would be, so let's, instead of 50 Kobo, let's make this 51 Kobo, right? The maximum, like the bare minimum that this value can increase by, as far as our Nigerian Naira is concerned, is it can go up from 10 Naira 51 Kobo to 10 Naira 52 Kobo. And that's the smallest value by which it can increase by. However, as Forex traders, there is some other value, right, that we are also concerned with. It's just like the way we think about time, we think about seconds, right? We don't think about microseconds. But when an Olympic runner is running, they look at microsecond. So while everybody else is looking at second, they are looking at microsecond. Same way, while everybody else is looking at 10 Naira 51 Kobo or $1.21, we are looking at 10 Naira 51 Kobo 00 pip or 01 pip, right? So it takes about 100 pip to make 1 cent, or in this case, to make 1 Kobo. Now, so what this means is this: normally, if you're looking at this and you're trying to make money, you need this to appreciate from, if it increased by, so let me clean this too. If it increased by 50 Kobo, it will just go from 10 Naira 51 Kobo to 10 Naira or 11 Naira 1 Kobo, basically. But for you as a Forex trader, that is over 1,000 pips, right? Over 1,000 pips, right? So in the same vein, when we now combine it with lot size, when we are placing a trade, you can place trade on the market using different types of lot size. There's a standard lot, there's a mini lot, and there's a micro lot, right? Now, for a standard lot, in a standard lot, each pip is worth approximately $10. So just think of each pip is equal to $10. That means if you buy and price goes in your favor and you make 10 pips, just 10 pips, you just made yourself $100 using a standard lot. If price moves 10 pips in your favor and you're trading using a mini lot, you just made yourself $10. And if price moves 10 pips and you're using a micro lot, you just made yourself $1. So, which is why that calculation of this explanation here is saying that the profit or loss that you make is equals to the number of pips you captured. So if we make 50 pips, right, times the value of our lot size. So if we use a standard lot where 1 pip is equals to $10, well, we just made $500 in that movement, and price has not even appreciated by 1 cent. Do you understand? Price has not even moved up by 1 cent, but you've made $500 because of trading in the CDF market. Okay, so this is the reason why the forex market is, like I like to say, is the hardest way to make free money. Okay. Okay, somebody says, how is stop loss and take profit placed in video trading? Don't worry, when we get to that class, I would actually be showing you what the MT4 looks like, how you can place the trade on your market, and where you can place stop loss and take profits, right? Don't worry, those are for subsequent class, right? But it's very easy. You click it, you select, you put in the inputs for your stop loss and you put in the inputs for your take profits, and boom, you're ready to go. Now, so we're going to just quickly wrap up with this one before we call it a day. So with candlestick pattern. Now, not candlestick pattern, just candlesticks. Now, candlesticks, remember, well, I said most of what we'll be dealing with here are technical analysis. And technical analysis is chart analysis. That means we're looking at the market in form of looking at price charts, right? Now, so you would see those funny things that you see that looks quite confusing or looks like, medical heartbeat something. It's simply a representation of price, right? So candlesticks are just a representation of price, and they, what I call it, a much better representation of price than the other type of charts. Now, a candlestick shows you 4 key information, right? So there are 2 types of candlesticks. There is a bullish candlestick, and there is also bearish candle. So bullish candle, like we mentioned, remember we explained bullish and bearish. We said bullish means going up, bearish means coming down, right? So when it's going up, it's bullish. When it's coming down, it's bearish. So in a bullish candle, just simply means that price appreciated during that period, right? So as you can see, what this is telling you now is this. Well, this is the opening price. When you see a bullish candle, it can be green, it can be whatever color you set it to be. This is the opening price. It means this is where price opened for that period, right? Now, candlesticks are relative to charts. So if you're looking at a daily chart, that means every single candle represents 1 day of trading. If you're looking at a 1-hour chart, it means every single candle represents 1 hour of trading, right? So let's say we are looking at the daily chart, right? Let's just use the Naira, for example. Let's say by 12 a.m. This morning, let's say the Naira opened at, let's say, 580 against the dollar. Now, that doesn't mean that's where it's going to close for the day, but it opened at 580, so we register that as the opening price. Now, before the end of the day, well, price would be moving up, down, up, down, up, down, up, down, right? But let's say at one point in time, price actually dropped to like 576, right? So that was the lowest price that price dropped within this time frame. I mean, within this day. However, price ended up, there was a time price went as high as, let's say, 590, right? But eventually, by 11:59 p.m., price ended up closing, let's say, at 589. So you can see that we can see all of that information. Just, the candlestick pattern will show you all of that, and you can see that within this time frame, price opened at 580 and ended up closing at 589. So it's appreciated, right? The same thing can be applied whether you're looking at the 1-hour charts, the opening, the price at which you open, the highest price within that period, the lowest price, and at the point which it's closed. Now, the opposite to be for a bearish candle, it will mean that price is depreciated, right? So if it opens at, let's say, 580, right, and at one point it was as high as 590, but ended up closing at, let's say, 570. but there was a point where it was as low as 560, right? So the candlestick just shows you, it's just a representation of what price has done within a specific period. Now, a candlestick chart would look something like this, as you can see here now. You can see the candles, they don't have the same size, they don't look the same way, and you can see, so it's showing you price on your right hand side, right? It's showing you price on your right hand side. So you can see that in this case, when the price is depreciating, you can see price going down, right? Price is depreciating, and then when price is appreciating, you can see price going up. But each individual candle, which if you look here, it says British pounds / Japanese yen, and you can see 1D. That stands for 1 day. So this is a daily chart, right? This is the daily chart of the pound against the yen. Every single candle here represents 1 day of trading. You can see August, September, October. So this would have been maybe August 1st, August 2nd, August 3rd, like that, down to maybe August 29 or something like that, right? So you can see, let's say, for example, in this particular day here, this one that I circled, you would see that price opened here and closed down here. So price depreciated. Why in a case like this green candle here, price opened here and ended up closing up here. So price appreciated. But if you look down, you see a thin line, which we like to call candle wick. So think of a candle and a wick. So that thin line there represents the lowest point which price got to. And in this case, you can see this shows the highest point for that day which price got to, right? Don't worry, if it's still sounding a little bit confusing, don't worry. After subsequent classes, when you start playing around with this, it will start getting much easier. Okay, so like I've made mention multiple times, price in the market moves in waves. It doesn't move in a straight line. If price wants to go from a point A to point B, let's say price wants to go from a low price down here to a high price, it's unlikely that price will just move up in a straight line. What you find is that price would move in some sort of wave. And so this is the reason actually why we are able to trade the markets, because if we can predict the possible movement in price, if we can analyze the market looking at fundamentals and technical reasons for price movement, we can be able to get in on a price movement, the beginning of a movement, and actually take advantage of the price fluctuation, right? Now, when price moves, it moves in waves. And, let's say price is going from a point A, you find that price would move in, some sort of haphazard pattern, which is the reason why when you look at the charts, the first time you look at those charts, they look very confusing. And you start like, where do I start from? What am I seeing? What am I looking at right here, right? But what you would learn by learning how to analyze the markets is you would learn how to read the charts and how to spot opportunities in the chart. You would see that the market movement is not that random. It's not that random. As you see, look at this, what you have on your screen here, why it looks very random. When you start placing in certain lines, you start looking constructive. You start finding that, well, it seems to appear that price tends to respect certain areas, and then we can take advantage of those areas and look for buying opportunities or look for selling opportunities, depending on where we think price is potentially going to go, right? So don't worry. You would see this, you would find this gets more and more better or easier as the case may be. Now, so wrapping up, what do you need to start trading trading on the Forex market? Well, all you need is all available to you. All you need, you first of all need a mobile platform, right? You need a mobile device, right? So like a laptop or a phone or a tablet, any internet-enabled device that can download the MT4 application is the first thing you need. And I'm sure you have it, because you can't join me in this training if you don't have a laptop or a phone, right? So you already have that. And then an internet connection. Well, you already have that as well, because you can't join me in this class if you don't have an internet connection. And so I know you already have that. Now, trading on the Forex market does not even require high-speed internet or anything of the sort. Just your normal basic, a good internet connection is good, because all you need to do is just place trades, close trade, manage your position. And then you need a startup cap. You need money, obviously. The good thing is you can start trading with as low as $100. You can start with about 50,000 naira on a platform, and then definitely you need Anzo capital. So you need a brokerage platform because you can't trade in the market without, if you can't go to ShopRite and say you want to buy Euro USD. So you need to be able to turn out to, in order to assess the market, you need a broker. And that is why Anzo Capital were here to provide you seamless trading experience, to provide you top-notch brokerage services. Like I made mention that Anzo Capital, we are probably the best platform in the country. And I say that without with full confidence. We are actually the only 100% non-dealing desk brokerage firm in the country. And you can see some of our partners, our liquidity providers, as you can see down here. So you're trading directly with the markets, right? Some of our partners include the HSBC, Standard Chartered, the Bank of America, Citibank, JP Morgan, and all the top tier 1 banks and big LPs, right? So you can be sure that trading on the platform is seamless. We also offer you trainings like you're receiving now, advanced classes when you get better. Also, there are even classes to help you build your own trading robot. You've been hearing about robots. You can learn to automate your strategy and build your own trading robot. You'll be able to learn that, don't worry, as you keep going further in your learning. And then we also provide you classes for funded clients and people who have traded the market, or people who you're trading, I'll give you classes that will enable you to do better and become better analysts. We also provide you, signal groups where you can get Forex trading signals. And there are bonuses, there's 10% bonus, there's a 20% bonus that you can take advantage of if you fund your account today as well. So trading with Anzo Capital is probably the only thing you should want to do. And don't worry, we want you to get better, we want you to do well, and we want you to be profitable in the markets, which is why we continue to provide you ongoing support. Hence the question, what are you waiting for? Okay, so this will be the end for the class. For this session, I will then take your questions. This class would be made available for you online to be able to watch if you wish. So please, if you don't have an account yet, let me know. Just reach out, message me here privately or something with your phone number, and one of us would get across to you to help you set that up. Right now, remember, besides the fact that you could learn to trade yourself, right? Besides the fact that you could learn to trade yourself, we also have platform where you can do copy trading. So you can have other pro traders manage your funds while you are making money, while you are learning, right? So you can learn to, you can just copy the trades of professionals that are already on the platform and make money while they do, even though you don't have any experience trading at all. So that is one very important thing to also know. There's a copy trading solution or investment, however it is you like to put it, where you can copy traders and make money while they do. I'm going to answer your question. Somebody says, how can you make money when the market is bearish? Well, here's the beautiful thing, right? Remember, I made mention that when we're talking about trading, don't think of buying currencies as, you're buying just one thing. Think of it as exchange. Now, when you're buying, so let's say Euro USD, so let's just call it EU, and E stands for Euro and USD, U stands for USD. But if the price for EU looks like this, that means it's going up, it's bullish. When you buy, if we're buying EU, what you're doing is you are buying the euro and you are selling the dollar, right? If you're trading Euro USD and you place a buy, what you're doing is you are buying the euro and selling the dollar. So think about it as, so when you go to buy bottled water, so you want to buy bottled water, right? So you want to buy whatever it is you want to buy. Think of it as a transaction, like think of bottled water against your naira. In order to buy the bottled water, you have to sell your money to them. So you're exchanging. So in the same way, when you buy Euro USD, you are buying the euro and you're selling the dollar. So what that means is when you sell Euro USD, you are selling the euro and you are buying the dollar. That means if price is going down, that means if the market is now bearish, right? And price is no longer going up, but price is instead coming down. But what this means is if the chart for Euro USD looks like this, that means it is going down. What it means is the euro is getting weak and the dollar is getting strong, right? Which is why this is coming down. So it's like a tug of war. Please keep your mics muted. It's like a tug of war, right? It's like a tug of war where, so think about it, not necessarily a tug of war, think about it like you're trying to balance, two things or a number of things on the scale, right? So if you have, let's say, the pivot here, and then you have something like this. Now, if we have more stones here, right, and we have less stone here, what will happen? If this is the euro, right, and this is the dollar, well, because there are more stones, or this one is heavier, or this one is stronger, well, this scale will look like this, right? Because the weight of this one will be pulling this one down, right? Which is why you will see price go down. However, if this one becomes stronger, that means if more demand gets here, well, what will happen is the direction will tilt upward. And okay, the direction will tilt upward. If I can just draw this properly, like this, where this is now heavier than this one. So if the market, in this case, when price is appreciating, we are looking to buy that instrument. However, when price is depreciating, we are looking to sell the instrument because, well, we are in the case of an appreciating price, we are buying the base currency and selling the quote currency. In the case of a depreciating price, we are selling the base currency and buying the quote currency. I hope I answered your question. Okay, so yeah, I'm going to stop the recording now. Somebody says, how swift is your withdrawal? Well, our withdrawal is within 5 to 30 minutes, faster than almost every single platform. Many platforms withdrawals is like 2 days, right? Deposit and withdrawals on our platform is within 5 to 30 minutes, right? So very, very swift. You can deposit using the Naira, your local bank, like from your Naira account. You can deposit from your domiciliary account. You can deposit using Bitcoin or USDT. You can deposit using Skrill, Neteller. There are several options for deposit and withdrawal as well. Okay, so thank you very much. I hope you guys enjoyed the class. Please give me your feedbacks. Make sure that you all sign up an account if you don't already have one. And then if you do, get started either doing the copy trading or learning to trade and joining me in my classes. Thank you very much, and I'll see you later. So now time for your questions.